Founders Floor, a co-working accelerator for startups.
First of all, thanks very much for having me here. It's always great. I mean, this is what I love doing. It's talking to other people who are starting companies, who are trying to create disruptive businesses that are going to change the world in one way or another. So thanks very much for having me here. So a little bit of my background, born and raised in Argentina. That's why I have an accent. I'm not faking it. It's not playing the minority card. It's like I'm actually from Argentina. When I graduated from college, I couldn't get a job. So that's why I ended up starting a company. It's not because I wanted to be an entrepreneur. And being an entrepreneur in Argentina is not the same as being an entrepreneur in Silicon Valley. It's almost like, oh, you're unemployed. It's like, that's how my friends looked at me. And it was probably right. I mean, I couldn't get a job, so I started a company. It was an e-learning company. This was back in 2001, 2002. We were selling to large corporations in Argentina. We started getting some traction, and then Argentina went through a major financial crisis, which we do every now and then just to keep things interesting. And most of our customers said, great, we love your product, but we're downsizing, and HR and training is one of the first things to go. So we were going to shut down the company, and instead of shutting down the company, we decided with my co-founder to try to sell our software here. So we got a flight, a plane ticket, we landed here, but not in Silicon Valley. A lot of friends said, oh, you're going to the US, go to the center of innovation in the US, go to Miami. So we landed in Miami. It was a ton of fun. I mean, I had a blast. I was living in Miami Beach. I was single back then, and now I'm married. I've been married for many years. But back then, it was great. But I didn't get anything done business-wise. So we started getting some pull from government agencies. So that's why we moved the office to Washington, D.C. And that's where I started growing the business. I mean, we were building the business. We thought that we had everything figured out. And then in 2006, I got selected by an organization called Endeavor. They work with entrepreneurs in emerging markets. And they invited me to Silicon Valley for the first time. Had no idea Silicon Valley existed. So when I first came here, I was there sitting where you guys are, hearing from venture capitalists, from entrepreneurs. And that's when I said, this is where I want to be. It's like Miami, great, a lot of fun. DC, amazing architecture, but too cold. I want to be here. So we went back with my co-founder. We sold the company, and we were determined to move here. We moved here. This was 2010. I moved here. I was married back then, and we didn't have jobs. We just ended up here, and we rented a small apartment in what we thought was like a fancy area of Palo Alto called East Palo Alto. That's the only thing we could afford, and it was a lot of fun. I mean, I was super productive. I would stay inside the room for as long as I could because I didn't want to go out. And that's how I connected with the folks at Emergence, a venture capital firm. And I told them, look, I don't want to be a venture capitalist. I just want to understand how venture capital works so that then when I start my next company, I can raise money from you. And this was 8 years ago, and I'm still in venture.
Yeah. How does being a successful entrepreneur prior to this and then being on the dark side, I mean the VC side at that point, does that help you? Does that help you become a better VC, you think, being on both sides of the fence, if you will?
I think it does because I want to feel that Emergence is a startup. I mean, we're a small venture capital firm. We've been around for like 12, 14 years, so we're still emerging. And we don't have everything figured out. I mean, what got us here is not what's going to get us there. Early on, we decided that software as a service was going to be a big category when everyone thought, oh, that's stupid, why are you wasting your time? We invested in a small company called Salesforce.com. That worked out really well. And now we are still trying to figure out what's next. Now, our category has become a huge category. If you think about enterprise cloud, now everything is enterprise cloud. So what's going to happen within enterprise cloud? So what's going to be the next software as a service? So as a venture firm, I want to think that we're operating more like a company that an asset management firm. We don't think of like asset allocation. We are very thematic. We pick 3 themes at any point in time within enterprise that we're interested, and we have quotas as investment professionals that we need to meet, and we track our quotas. Top of the funnel, how many new companies are we meeting with on a quarterly basis? How many of those companies are making into investment team meetings? How many of those companies are going into diligence? How many of those companies are we giving a term sheet to? And how many of those are converting to closed deals? So we're very metrics driven, and we operate like a company. Does it help me having a background as an entrepreneur? Probably yes. Because I don't take anything for granted. And also there's like immigrant mentality where you don't take stuff for granted. You just work, and you're never done.
Yeah. Following up on that immigration path for yourself, I think Silicon Valley is just a magnet for, some of the best entrepreneurs in the whole world to want to come here to start their companies, and for you coming here from Latin America, can you share with us maybe some of your immigration path that you did? You mentioned, coming over here into Miami, but was there some trials and tribulations throughout the whole process, be able to get here?
Yeah, totally. I mean, when I first moved to Miami, I told my family and friends that I was going to be here in the U.S. for 2 months and then go back. And this was like, 12, 14 years ago. I always felt I was never fully in the U.S. because I had my network in Argentina. I still have my strongest network in Argentina. But that's where Silicon Valley embraced me like no other place. In Miami, I still felt that I didn't belong. In DC, I also felt I didn't belong. Then I spent 2 years in Boston, same thing. And when I moved here, I realized that most of the people here are from somewhere else. People were not asking me, what did my family do? What was my last name? They didn't care. They care about what I was working on and not what got me here. And for me, that was inspiring.
Yeah. Actually, I grew up on a farm in Iowa, so sometimes I feel like an immigrant coming from there. It's kind of a night and day difference. But so what are some of the differences? I mean, because now that you've, at Founders Floor, we have a lot of individuals that are coming here from different type of visa statuses as well, and so, what's your feeling in regards to how it was then compared to now in regards to coming here and being able to start a company as an immigrant, and how that's maybe changed? Do you feel like there's maybe a brain drain that's happening in Silicon Valley because of the way things are happening with visas and current administration and things like that?
We're not going to get into politics, but I don't see a brain drain.
Good.
I see a lot of complaining. It was hard for me to come into the U.S. Almost a decade ago. It wasn't easy. It's like I remember coming in with a tourist visa and then going back and then coming again and playing that game for a long time until I figured out a path, which wasn't that easy either. So I feel things were hard back then. They're still hard, but entrepreneurs are going to figure that out. If you get stuck there, it's going to be very hard to build a company because you're going to have much bigger problems than getting a visa when you're running a company.
Yeah, true. We touched upon this a little bit. I want to talk about it more, top talent in the Bay Area. But, in regards to Emergence Capital, I mean, you guys have invested in a lot of great founders and companies. And, a lot of those founders were individuals that, people didn't know about prior to that. And I'm just going to go off on a little bit of a list here so that the folks in the audience know some of those. I mean, Emergence, invested in Yammer with David Sachs, Aaron Levy, Box.net, Eric Yon, Zoom, Salesforce.com, obviously, with Mark Benoff. I mean, that's a heck of a list. How do you guys spot early talent like that? And early, I mean, I know it's a loaded question, but I mean, these names that we all know about now, I'm not saying there were nobodies before, but nobody really knew about them before.
I think the way we cheat is by being focused. So we just do one thing and we try to do it really well. And that's what any company should do early on, is do one thing and be the best at that. Define your own turf rather than, oh, I'm going to boil the ocean, because that's going to be really hard. So for us, focusing on that software as a service category early on allowed us to see every company in that space. So when you see every company in the space, you develop that pattern recognition that enables you to pick the best. Hopefully, you're going to be right about the category, so then the best company in that category is going to make it. But our strategy has always been to focus, talk to every company in the categories that we deem interesting, and then pick the best company. And picking the best company is not picking the best metrics or the best logo. It's all about the founding team and the culture, at least for us. So we spend a lot of time with the teams. We try to understand what makes them tick. I mean, why are they doing what they're doing? If they're just doing it because they want to make money, it's probably not the right motivation. It's a very long journey. It takes a lot of work. It takes a lot of time. So you need to love what you're doing in order to make it worth it. So that's what we're trying to understand as we spend time with entrepreneurs. And whenever I decide to partner with an entrepreneur, I try to get to the bottom of it. It's like, even if this doesn't work out, are you going to be happy about the journey? Because the odds are against all of us. And if you think about all the companies that get started, the majority don't make it. So if you start with that and you're still going to feel great, even if you don't make it, then you should do it. If not, just get a job somewhere else.
Yeah. You guys, absolutely kind of the godfather of SaaS, if you will, in regards to VC firms. And, you guys really moved into that early. You guys also invest in really Series A and beyond, maybe a little bit in seed, maybe sometimes, I guess. I don't know.
No, we're super focused on Series A.
Okay.
So out of each fund, now we're investing out of our fourth fund. We will probably invest in about 19 to 21 companies. So not more than that. And for that to work, we need to be very focused. We invest in about 5 to 7 new companies a year. So again, very focused. We need those companies. First, we need good ownership in those companies, given the stage that we invest in. And we need those companies to be at a stage where the product phase has already been validated. We call it early revenue. So we don't invest pre-product market fit. That's not what we're great at. Our DNA is not going to be able to help those companies figure out product market fit. What we've done over and over again is help companies scale sales and marketing. That's what we love doing. That's where we have a pattern recognition, and that's where we have our network. So when we invest in a company like Zoom, very early stage, early revenue, we know what to look for. We know the type of people that they need to hire. We know how to talk about pricing, how to talk about ICP, ideal customer profile. So that's what we love to do.
Gotcha. So, all right. So really, the good time for companies who are fundraising, now maybe in the audience and others is to know when to approach you is maybe when they're ready to raise a Series A, or maybe after they've raised that seed round for themselves, and they're really meeting some milestones they need to hit, and they're starting to hit some metrics that are going to make them get closer to that Series A round. That's a good time to maybe reach out to you guys and be on your radar at least? Is that?
Yeah, I mean, I think reaching out to Series A investors or Series B investors super early on, when you still don't have that early product market fit, is going to waste a lot of your time. Because from my point of view, I'm going to take meetings with all of you, because it's like, yeah, I want to learn. I just want to make sure that I know what's out there. But for you guys, it's going to be a waste of time if you do that with Emergence, with other firms. So once you raise that seed round, you should focus on getting to that early product market fit. Once you feel that you have something figured out and you're on a great trajectory, that's when you start building relationships. Not right before raising a Series A, but somewhere in between. Because at the end of the day, if you're going to end up raising a Series A round from an investor, you're going to be partnering with that investor for 7 to 10 years. So you don't want it to be like a speed dating 3-week process where you need to commit to someone for the next 7 to 10 years.
Mm-hmm. What are some of those KPI metrics that you like to see in startups that are SaaS focused, but more importantly, what do these businesses need to focus on themselves from a KPI point of view to be able to build a high growth business and to get to the point where they can be tantalizing enough to be able to go and potentially, get an investment from Series A type of VCs? What are those KPIs?
Given our stage, what we focus on is customer adoption. And customer adoption is not just you have 6 customers, 2 customers, 10, 100. It's like, I'm going to call a few of your customers. What I want to hear is, if you turn this off, I'm going to quit my job and switch industries. You can't turn this off. When we hear that customer love from 1, 2, 5, or 10 customers, that's what gets us. Because that shows us that there's early product market fit. Now we need to get more of those customers.
Yeah. Some of those acronyms that get thrown around in the SaaS world that startups absolutely have to start monitoring and optimizing. And maybe we can walk through some of those, and maybe you can help the audience kind of understand what those acronyms mean, and maybe what some of the metrics need to be associated with those, like MRR, ARR, churn, LTV, CAC. These are all like kind of sometimes crazy metrics, but the reality is they're super important once you get to that point where you're looking to build a really big business and vie for a Series A funding.
Yeah, and there are too many metrics to focus on. There are very few that really matter. For us, the ones that really matter are churn and engagement, because you might have low churn, but if you're signing up annual contracts and none of those contracts have come to the point where they need to renew, your churn is going to be 0. That doesn't mean that people are using your product. So that's why engagement is a great complement to that churn metric. Because if you sold someone an annual contract and they're not using it, guess what? They're going to churn. It's just that it hasn't happened yet. So for us, those metrics matter a lot. Then as you start scaling, we try to focus a little bit on what we call sales efficiency. And the way we measure sales efficiency is by looking at how much money do you need to spend in sales and marketing to get a new dollar of annual recurring revenue. So you put in $1, how much do you get out in that first year? And in the early days of software as a service, people were spending between $2 to $4 to get a new dollar of ACV. That meant that you had to wait at least 2 to 4 years, if not more, to get repaid your customer acquisition cost. And that's because a lot of it was field sales, so it was very expensive. Now with networks and viral products like Dropbox or even Zoom, you can see companies spending 60 cents or 50 cents to get a new dollar of ACV. Those metrics are quite compelling. Typically, we see a 1-to-1 ratio for most of the companies. You spend $1, you get $1, and assuming your churn rate is not too bad, then you're going to start making money in that second year.
For a SaaS company that's has a product that doesn't necessarily need boots on the ground type sales force, what type of month-over-month metrics or quarter-over-quarter metrics growth do you like to see in those types? I mean, do you need to see 20% growth of user or MRR, or because there's kind of 2 different types of groups. Sometimes there's the enterprise type who year-long contracts, the sales cycles 3 months just to get in after a paid POC, and then once they're in, they got to do something really stupid to get kicked out, And then you got the others that are more like a Box.net type, where once you're earning their business kind of almost every month, every quarter, so to speak, and then you can go into long-term contracts, and so you can kind of guess what the growth needs to be earlier on and what they need to hit, as a goal.
Yeah, I mean, we like to see MRR growth. That's kind of the most critical metric. But there are some businesses where you first need to build a network before you can start monetizing. So it makes no sense to slow user adoption just in order to show monetization. Examples of that are companies. We invest in a company called Crunchbase, probably a few of you are using. And there, building the network is more important than monetizing it. It's like LinkedIn in the early days. Don't monetize it. Don't charge people early on, because then you're not going to build a network. And make sure that the free product is great, so that people use it. And then the paid product is a lot better, so people are not only using the free product, but they want to convert to the pro version. So it's a delicate balance. You need to figure out what matters to you. And in the case of Crunchbase, the more people we have using Crunchbase, the better data we're going to have. So we don't want to slow down that growth.
You know, I kind of feel like there's this glut, there's this kind of zombie land of companies that, you know, raises pre-seed to seed, and they're trying to build up the revenue and their metrics to be able to raise a Series A. They just don't have the metrics to be able to do that yet. They're generating revenue. Some of them are ramen profitable, you know, but they just can't get to that next step. Do you see that as well, and if you do, you know, what are some suggestions on what these companies need to do, can do to get out of that?
To be honest, we don't see a lot of those companies. We see companies that have raised a seed or a second seed or a third seed extension, but by the time they raise the A, it's either they go up or they go down. We don't see a lot of companies bouncing up and down. We see a lot of those that are raising multiple seed, but that's okay because you're trying to figure out product market fit. So you tried something that didn't work, you moved on and you tried something else, but by the time you're raising your Series A, you should have that product that works and you're going to scale that. So by the time you're raising your Series A, you're going to be hiring a lot of sales and marketing people. So those sales and marketing people are either going to sell or they're going to just consume all your capital, and then you're going to have to shut down.
You've seen a lot of, you know, probably thousands of founders in the SaaS space throughout the years. Do you see any kind of characteristics in that founding team that you like to see, whether it's, you know, age or business experience or, you know, domain expertise? Is there kind of some of those things, boxes in your mind you like to have checked off, those founders?
Yes, I mean, we talk a lot about what's the ideal CEO profile, and it's not necessarily age, it's not necessarily domain expertise, it's more about what do they know that nobody else knows. So what's the unique insight? And again, it goes back to what drives them to do this. Why are they doing it? So for us, it's our diligence process is more about getting into the heads of the founding team to figure out why are they doing what they're doing. Because starting a company, it's hard. It's a lot of work. So you need to be doing it for the right reasons. And then we like to partner with people who are doing things for the right reason, not just generating money and returns. We feel that we can do that and at the same time have fun doing it and helping great people rather than just building companies.
You know, Emergence has always been focused in SaaS, and you guys were one of the first to embrace that. You know, and we're going on, you know, 18 plus years of that SaaS kind of model. What are some of those future trends that and opportunities that, you know, B2B startups and SaaS startups can take a hold of coming into the future? Kind of what is next beyond maybe SaaS?
Yeah, that's a good question. And at Emergence, we ask that question a lot. At any point in time, we only have up to 3 themes that we focus on. We believe that constraints make us better. It's like when you're running a company, if you have unlimited capital, that's going to be challenging because you're not going to be able to know what to do. If you have like customers pulling you in different directions, same thing, you're not going to build a company. But if you're constrained, that's going to force you to think twice before you do. And the 3 areas where we're spending a lot of time are, number 1 is industry cloud, number 2 is deskless workforce, and number 3 is coaching networks. The first one, industry cloud, is this notion that a lot of the SaaS 1.0 companies had to be horizontal because the market was small. So you had to sell CRM to everyone in order to build a big company. But now, given that everything has moved to the cloud, you can start focusing on specific verticals, life sciences, education, construction, and build a stack there. If you look at a company that we invested in called Viva Systems, that's what they did. They started with CRM for pharma companies, and they were very capital efficient. They raised only one round, about $6 million, And that's all it took for the company to go public. They're now a $10 billion plus company. And that's because they started in one industry. They had a limited number of customers. They built great relationships, and they started adding more products on top of their original offering. Mm-hmm. The second category, this idea of deskless workforce, is if you think of most productivity apps out there, were designed for people sitting at a desk, people sitting with a desktop computer, a laptop, or something similar, were not designed for mobile devices. 80% of the global workforce is not sitting at a desk. They're mobile. So we believe that the next generation of productivity apps is going to be designed for mobile usage versus desktop with a mobile companion app. And the third one is the idea of the coaching network. And the way we define coaching networks is, if you think about artificial intelligence and you apply to enterprise, we believe that most applications, CRM, customer support, and you name it, are going to be displaced by their equivalent with artificial intelligence. And just to give you one example, we invested in a company called Chorus, and what Chorus does is they listen to a call. Let's say that I'm a Zoom sales rep. I'm on the phone with a prospect. The technology is listening to that call, and based on what's being said and how things are being said, as a sales rep, I get real-time coaching. As you're talking to an introvert from California, they just asked about this competitor. Based on all that information and on past deals, this is the best answer to close the deal. Mm-hmm. And then based on the outcome, if it's a close won in Salesforce or lost, the technology learns and keeps adapting. Mm-hmm. So what we believe is that that type of technology is going to help us achieve a much higher level of human productivity, because it's going to help us be more effective. It's not going to replace us. It's not automation. It's augmentation. It's helping this common knowledge that now is being lost because it's hard to aggregate, and that's going to be intersected into the workflows, making the workflows a lot more efficient.
I want to save some time for some Q&A from the audience here. So I got one final question, and then we'll go ahead and pull some from the audience. So get your questions ready if you can. But I am envious of people who travel internationally, enjoy that. We have a lot of founders here that they get these great deals and just go off everywhere for a week. And I get to go and live vicariously through them. You love to travel internationally, and I think one of your goals is try to hit 50% of the countries in the whole world.
Yeah.
What percent are you at right now?
So I'm close.
Okay.
I'm close. I did a lot of that before moving here, backpacked for a long time. And it was awesome. I think it also helped me understand how different people think about opportunities. Here we live in this is a bubble. We're always thinking about that incremental innovation because most of the basic infrastructure is already built. And we sometimes forget that the rest of the world still needs a lot of that basic infrastructure. And a lot of the rest of the world is going to leapfrog from having nothing to having supercomputers in everyone's pockets. Mm-hmm. So what are the applications that are going to be possible because of that? Think of blockchain technology and Bitcoin. It probably doesn't make sense to have another payments method here in the US because I'm sure a lot of you, or if not most of you, have at least a credit card or a bank account. My friends in Argentina, my classmates, they don't. And that doesn't mean that they are poor. It's just that they operate with cash. They want to buy the same apps, the same songs, the same products on e-commerce that we all buy, but phones don't take cash. So that's why the idea of digital money is not incremental, it's revolutionary for those economies. So that's why for me traveling is more about opening my mind to stuff that's going to be massively disruptive in the next few decades.
Let's take some questions from the audience here real quick. I'll walk the mic over so we can get it on recording.
Yeah, it would be great if you could give me a little bit of background on what you do, your company, before the questions.
All right, in the front here.
My name is Yi. I'm currently looking to start a company. primarily doing working with Apple Business Chat. So my background is technical, and I know you said that you primarily deal with Series A, so maybe you don't have this kind of problem. But when doing B2B, a lot of it's about selling. So what would you recommend to people who are technical, like in terms of selling to companies or finding somebody who can sell for you to get those first couple customers?
I would say early on, I would rather have a technical founding team than a sales team, because the sales team is going to be able to get customers and promise everything. It's like the promised land without building anything. And that could get you to a great trajectory early on, but long term, that's going to kill you. If you're a technical founding team, you're going to build something that people use. And I mean, Eric is the founder of Zoom, is a great example. He's a technical founder. He was solving a real problem. And he spent a lot of time solving it without taking shortcuts before he started accelerating go-to-market. So early on, try to solve a problem. Once you find the problem that you're solving, then you might want to partner with someone who can help you accelerate that. But early on, just focus on the technical challenges.
Got a question in the back here.
Hi, Santi. Irving Chin. We're working on a community-based platform for college student success to basically organize institutions and third-party nonprofit organizations to kind of build a network around customer student success. The question I had was, you invest in 5 to 7 companies a year, and you probably see hundreds in a given year, and they're all meeting those thresholds of metrics, for SaaS. So there must be something that kind of stands out between these 5 to 7 companies from hundreds of opportunities that are all seem like probably excellent ideas and excellent businesses, right?
Yeah, I think for us, it's a number of things. One is we know what we know, so we focus on the areas that we're excited about. Even within B2B, we typically don't look at companies that are focusing on security or infrastructure. If I'm talking to a company that's doing security, I'm asking myself the question, why are they talking to me? I don't have a security background, and I don't know if this one is the best company in the security landscape. So they need to be within our swim lanes. Second, we want to believe that the CEO and the founding team are swinging for the fences. They want to build something huge, and not just economically big. It's that they want to build a big company. And third, we focus on the metrics. I mean, we look at the metrics and we try to figure out if this company can scale. But we start with our themes. I mean, we see a lot of companies that don't fit our themes. We're not that excited.
Got a question in the back here.
Hi, Santi. Thank you. My name is Sandeep. We are building a SaaS platform for predictive maintenance focused on the energy side. Question was 2 questions. One, you mentioned engagement because churn may not be measurable in the early stage. What are things that let's say we should be thinking the metrics and engagement that we should be tracking so that we can present to investors. And second, valuation, right? It's kind of how should we be thinking about understanding the valuation, or is that important even that seed stage even for that matter?
Those are 2 good questions. The first one on engagement, sometimes we ask people, what's the engagement on your platform? And they don't have an answer, and they feel, our customers are logging in once a week. That's not good enough because I use, email many times a day. But for some applications, once a week might be good enough. So you need to define the metric of success based on your specific use case, and then figure out if you're tracking towards that. And then what percentage of users are tracking towards that metric. I'll give you an example. Zoom, they have high engagement, but it's not that everyone's on a video conference call every 30 minutes. Some people are just 1 video conference a day or 1 a week, and that's fine. Some other applications, you need daily engagement. Some other applications you need to have open all the time. So based on what you do, try to figure out what's a metric of success. And the metric of success when it comes to engagement is how important are you for your user? Not necessarily the customer. It's whoever is using your product, how important are you? If you go out and you turn it off for a month, are they going to call you? Are they going to care? If Zoom, I mean, fortunately they don't go down, but if they go down, I mean, we're going to have a riot here. People are going to be, they're going to be totally frustrated because they rely on Zoom. And the second question, in terms of valuation, I wouldn't obsess with valuation. I think at the end of the day, what matters is that you get the right partner. And people are going to have different ownership thresholds. So for example, for us, we're typically targeting a 20% ownership in a company at the Series A. And to be completely honest, it doesn't matter to us if we're writing a $4 million check, $5 million check, $6 million check, because that's not where we're going to generate the return. We're going to generate the return with the ownership that we have. So we'd rather pay a little bit more to get that 25% ownership, but then we need to justify the stage of the company based on the amount of money that you're raising. It's not a discounted cash flow model. It's more about an iterative process where you come up with the amount of money you need, and then you try to find a solution given what's the target ownership that your investor has.
Question in the back here.
Hi, Santi. My name is Avi. I'm from Weaver. We are building a developer listening tool for businesses. And the question I had was if you have seen any patterns regarding how the traction comes from a freemium model to a trial-based model, which is then paid after 14 days, 15 days kind of thing. Have you seen any patterns in the business enterprise side of this?
Yeah, I mean, we have a lot of experience with freemium and trial models. And freemium works when you know exactly where to build the toll booth. Sometimes freemium models, the free product ends up being a competitor to your paid product because free is good enough and then people don't need to upgrade to paid. And we saw that with Yammer early on. They had a freemium model, and Yammer's biggest competitor when they were trying to sell was the free product because it was good enough. There was no incentive to upgrade. With Zoom, what they found was that most business meetings are 40 minutes or longer. Most like non-business meetings can be 15 minutes or 30 minutes or 40 minutes. So with Zoom, you get full functionality for free for up to 40 minutes. And then if you care about it and you're running a business, you're going to have to upgrade to get to an hour. They found this magic toll booth that works really well. But I don't think there's a silver bullet for every company. And free trial, it's sometimes tough because free trial needs to be self-explanatory so that people can get value without you getting involved. If the free trial requires a lot of hand-holding, it's going to be very hard to scale.
We have time for just a couple more here.
How you doing? Michael Purnell from Sacramento. I have a startup called C-Event, which is a VR ticketing platform that lets you buy virtual tickets so you can attend concerts or sporting events right from your own home. My question is, we're early stage. We got some revenue, but there are a lot of metrics out there that we need to look at to make sure we're on the right track. And it's becoming like a lot of time consuming gathering all the data. So I was wondering, is there like an online service or Excel template that's already out there that we could probably, look into so we could automatically plug and play all our metrics so we don't have to spend like a couple of days just gathering all and make sure we're on the right track? And the second question is, for early stage startups, I kind of want to get into the head. Of going Series A, just knowing how it works. Like, is there a program or a book or just some mentors that I could talk to, so I can just learn more about Series A, so I can basically have my startup, looking towards that way.
Sure. So first question, resources. You can go to SaaSplaybook.com. That's one of the resources that we put together with information about companies that we see and trends that we're seeing. You can also use a lot of Jason Lemkin's data, SaaSter.com. And that's where you're going to find a lot of great templates. And then SaaSter, yeah. And then on the second question, I mean, talk to this guy. I mean, he can connect you to everyone. He can help you with mentorship. He can help connect you with Series A investors, with the right mentors. He can help you craft your business. So yeah, you have the right answer here.
Got one more question in the front, and that's all we have, I think.
Hi, I'm Greg Costello. Santi, thank you so much. Your advice you're giving is just awesome. So we have a startup. It's a B2B AI startup focused on enterprise, particularly in the pharmaceutical sector. And we launched our application, our platform about 2 months ago. We already have 8 POCs in the works.
That's great.
We actually have one of our customers already expressed interest in putting money into the company as a corporate investor.
Be careful with that.
That I was going to ask. So if we raise our seed round all through corporate investment as an institutional investor or as a VC, do you frown on that?
Yeah, that's going to be challenging because generally when the round is dominated by corporate or strategics, they can pull you in the wrong direction. So it's okay to get them involved if they're a minority in the round. You also want to avoid giving them information rights, and then you want to build a consortium with a few of your potential customers so that people don't feel that this is part of company A, company B, or company C. So yeah, I mean, be very careful with that. These guys are buying information rights. They just want to know what you're up to and figure out if they need to buy you or not.
Santi, I know you got a dinner you need to get to, but I want you to know we appreciate you spending your Thursday night with us and making time for us. Really appreciate it. Let's give them a warm round of applause one more time.
Thank you.